AAA INT Advanced Audit and Assurance International. AAA INT Specimen answers 1 briefing notes to audit engagement partner from Crux Group. Audit Planning Introduction. These briefing notes are prepared to assist with planning the audit of the Crux Group, the group for the financial year ending 30 September 20x5. The notes contain an evaluation of the audit risks which should be considered in planning the group audit, which has been structured to prioritize the risks in terms of the likelihood and magnitude of misstatement in relation to each risk. The notes also recommend the audit procedures to be performed on the group's segmental disclosure of revenue. Finally, there is a discussion of the matters to be considered by Pegasus & Company in relation to a proposed additional engagement to advise management on the group's social and environmental information, evaluation of audit risk materiality for the purposes of these briefing notes. The following overall materiality level will be used to assess the significance of identified risks and as requested. This has been based on the profitability of the group benchmarks using profit before tax or operating profit as a suggested benchmark provides the following range: 5 to 10% of profit before tax equals range of $4.05 million minus $8.1 million. 5 to 10% of operating profit equals range of $7.25 million minus $14.5 million. These benchmarks are only a starting point for determining materiality. Need to be applied in determining a final level to be used during the course of the audit. As this is a new client and therefore an initial audit engagement due to the increased detection risk, materiality should be set at the lower level of the range at $4 million. New audit client. The group is a new client, our firm having been appointed 6 months ago. This gives rise to detection risk, as our firm does not have experience with the client, making it more difficult for us to detect material misstatements. However, this risk can be mitigated through rigorous audit planning, including obtaining a thorough understanding of the business of the group. In addition, there is a risk that opening balances and comparative information may not be correct, as the prior year figures were not audited by Pegasus & Co. if any misstatements existed in relation to the opening balances. This would have a significant impact on our ability to gather sufficient and appropriate evidence over closing balances. As such, we should plan to audit the opening balances carefully, in accordance with ISA 510 Initial Audit Engagements, Opening Balances, to ensure that opening balances and comparative information are both free from material misstatement. Revenue recognition and audit risk arises in relation to the timing of revenue recognition. Given the requirement of ISA 240, the auditor's responsibilities relating to fraud in an audit of financial statements, that when assessing audit risks, the auditor shall presume there are risks of fraud in relation to revenue recognition. This could be a significant area of concern. It is appropriate that customer deposits are recognized as deferred revenue when they are received. This is in line with IFRS 15 revenue from contracts with customers, which requires that revenue is recognized when a performance obligation is satisfied, and therefore any amounts paid to the group by customers before a cruise begins are not revenue and should be deferred. However, the policy of recognizing all of the revenue from a ticket sale when the cruise starts may not be in line with the principles of IFRS 15 because the group is performing its obligations over time, which may be as long as a 6-week period for some cruises. This is a problem of cutoff, meaning that recognition of all revenue at the start of a cruise could result in overstated revenue and understated liabilities. Upgrade and maintenance costs. The group incurs high costs in relation to upgrade and maintenance of its fleet of ships. For the Sunseeker ships, $75 million is being spent this year. Based on initial materiality calculations, this amount is material to the financial statements and represents 92.6% of profit before tax and is therefore extremely significant. There is an audit risk that costs are not appropriately distinguished between capital expenditure and operating expenditure. Upgrade costs, including costs relating to new facilities such as gyms, should be capitalized, but maintenance costs should be expensed. There is a risk that assets are overstated and expenses understated if operating expenses have been inappropriately capitalized. A further risk relates to depreciation expenses, which will be overstated if capital expenditure is overstated. Component depreciation. IAS 16 Property, plant and equipment requires that each part of an item of property, plant and equipment (PPE) with a cost which is significant in relation to the total cost of the item must be depreciated separately. There is a risk that ships in use are not broken down into component parts for the purpose of determining the individual cost, useful life, and residual value of each part. For example, if significant, the gym equipment should be depreciated over 3 years and therefore requires separate consideration from other assets such as ship exterior, engine, etc. There is an audit risk that depreciation is not correctly determined on this component basis, meaning that the assets and their associated depreciation expense could be over or understated in value. This risk is also heightened due to the unusual movement in relation to the accumulated depreciation figure, which has only increased by $49 million in the year. Information is not given on the group's depreciation policy, however, compared to the total cost of PPE at the financial year end of $2,304 million. This equates to only 1%, which appears quite low, suggesting understatement. Cybersecurity attack. The recent cybersecurity attack could highlight that internal controls are deficient within the group. Even though this particular problem has now been rectified, if the group internal audit team had not properly identified or responded to these cybersecurity risks, there could be other areas, including controls over financial reporting, which are deficient, leading to control risk. The situation could also indicate wider weaknesses in the group's corporate governance arrangements, for example, if the audit committee is not appropriately discharging its responsibilities with regards to internal audit. Tutorial note: based on best practice, the audit committee should review and approve the annual internal audit plan and monitor and review the effectiveness of internal audit work. The audit committee should ensure that the internal audit plan is aligned to the key risks of the business. Credit will be awarded for discussion of these issues in the context of the cybersecurity attack. In addition, the cybersecurity attack could have resulted in corrupted data or loss of data relating to the sales system, if the customer details were integrated with the accounting system. There is an audit risk that reported revenue figures are inaccurate, incomplete, or invalid. Though the issue could be confined to the sales system, it is possible that other figures could also be affected. Finally, the cybersecurity incident is likely to result in some fines or penalties being levied against the group, as it seems the risk was not properly dealt with, leaving customer information vulnerable to attack. It may be necessary for the group to recognize a provision or disclose a contingent liability depending on the likelihood of a cash payment being made, and the materiality of any such payment, in accordance with IAS 37 provisions. Contingent liabilities and contingent assets. The related audit risk is understated liabilities and understated expenses are incomplete disclosures if any necessary liability is not recognized, or disclosure not made in the notes to the financial statements. Related party transaction. It appears that Vela Shipbuilders Company, which is building new Explorer cruise ships for the group, is a related party of the group. This is because Max Draco is the chairman of both the group and Vela Shipbuilders Co. According to IAS 24 related party disclosures, a related party relationship exists where a person has control or joint control, significant influence, or is a member of the key management personnel of two reporting entities. The fact that Max Draco's son is the chief executive officer of Vela Shipbuilders County also indicates a related party relationship between the group and the company. IAS 24 requires that where there have been transactions between related parties, there should be disclosure of the nature of the related party relationship as well as information about the transactions and outstanding balances necessary for an understanding of the potential effect of the relationship on the financial statements. There is an audit risk that the necessary disclosures regarding the group's purchases of ships from Vela Shipbuilders County are not made in the group financial statements. The related party transactions are material by their nature, but they are also likely to be material by monetary value. The information provided does not specify how much has been paid in cash from the group to Vila Shipbuilders County during the year. But the amount could be significant given that the group has presumably paid any final installments on the ships which have come into use during the year, as well as initial installments on the new ships starting construction this year. Operating licenses. The group's operating licenses of $56 million are material to the financial statements. It is appropriate that the licenses are recognized as intangible assets and that they are amortized according to their specific useful life. However, an audit risk arises due to the possible impairment of some or all of these licenses, which arises from the governments having withdrawn the licenses in some countries where the group operates their pioneer cruises. While the license withdrawal is apparently temporary in nature, the withdrawal is an indicator of impairment, and it is possible that the operating licenses are worth nothing, so should be written off in full. Management should conduct an impairment review in accordance with IAS 36 impairment of assets to determine the recoverable amount of the licenses, and if this is less than the carrying amount, recognize an impairment loss accordingly. If this does not take place, the intangible assets are likely to be overstated and profit overstated. Tutorial note: credit will also be awarded for discussion regarding derecognition of the operating licenses as well as their reduction in value, and for considering whether the Pioneer cruise ships also need to be reviewed for impairment. Borrowing costs. The ships being constructed fall under the definition of a qualifying asset under IAS 23 borrowing costs, which defines a qualifying asset as an asset which takes a substantial period of time to get ready for its intended use or sale. This includes property, plant and equipment during the relevant construction period, which for the ships is 3 years. IAS 23 requires that borrowing costs which are directly attributable to the acquisition, construction or production of a qualifying asset should be capitalized. The audit risk is that interest costs have not been appropriately capitalized and instead have been treated as finance costs, which would understate assets and understate profit for the year.